Hello students, a warm welcome to all of them. I hope you all are doing good and fine. In our today's session, we will start with the chapter number 17, Computation of Gains and Tax Payable. So students, from our today's session, we will be starting with the capital gains tax known as CGT. So students, under this topic of the capital gain tax, we will be covering a total of 5 chapters. The first 4 chapters will deal with the CGT relating to individuals, and the last chapter, that is the 5th chapter, will cover the CGT implication for companies. I hope this is clear. Now moving forward to the chapter learning objectives. Describe the scope of capital gain tax. Recognize those assets which are exempt, the assets on which capital gain tax will not be applicable. Compute and explain the treatment of capital gains. Compute and explain the treatment of capital loss. Compute the amount of capital gains tax payable. Understand basic capital gains tax planning. These are the 6 areas we will be covering under this chapter. So students, coming to the capital gain tax on capital gains, scope of the tax, chargeable disposal, chargeable asset and chargeable person, gains or loss of an individual asset, disposal proceeds, allowable costs, what are the costs which will be allowed, taxable gains in a tax year, capital losses, and annual exempt amount. Then coming to the capital gain tax payable. So these are the 4 most important topics under this chapter. So students, as we have seen, the capital gains tax known as CGT. Students, the capital gain tax will be tested in your examination for 10 to 15 marks. Section B, 1 compulsory question, 10 marks, that is 2 marks into 5 question, MTQs, so 10 marks. 1 question in section B, surely it will be relating to the capital gains tax. Then if it will be also tested in the section C, where we have the 10 marks question. The section C 10 marks question can combine both CGT and IHT. So I hope this is clear. So the capital gain tax is the most important area of the whole syllabus of the tax, because a sure question of 10 marks will be tested in the section B, students. So in our today's session, we will be covering the capital gains tax. Now moving forward, scope of capital gain tax. Capital gain tax is charged on the gain arising on a chargeable person making chargeable disposal of chargeable asset. So students, capital gain tax is charged on the gain arising on a chargeable person making a chargeable disposal of a chargeable asset. So the capital gain tax will arise on the gains arising on chargeable person making chargeable disposal of chargeable assets. I hope this is clear. Now, what does the term chargeable person means, chargeable disposal or chargeable asset means? We will be covering in more detail. So before that, students, moving forward, as we have discussed in our chapter number 7, the badges of trade. Badges of trade. To determine whether the transaction is of capital nature or trading nature. If capital nature, it will be covered under the capital nature. It will be covered under the CGT. If the transaction is of trading nature, it will be covered under the head of income from self-employment. Income from self-employment known as trading income. This will be known as trading income. Trading income, and the income tax will be calculated. But if the nature of the transaction, students, is of capital type, then it will be covered under CGT. This we have already covered in the chapter number 7. If the badges of trade applies to the transaction, then it will be covered under the trading head nature. If it does not comes under the head of trading nature, it will be covered under the head of capital nature known, and it will be taxed under CGT. So now we will be covering the rules for the CGT topic. As we have already seen, students, capital gains tax arises on gains capital gain tax is charged on gains arising on chargeable person making chargeable disposal of a chargeable asset I hope this is clear. The capital gain tax is charged on gain arising on chargeable person making chargeable disposal of a chargeable asset. So CGT implications will arise when there is a disposal by a chargeable person, when there is a chargeable disposal by a chargeable person of a chargeable asset. I hope this is clear. Now we will be covering in more detail what does chargeable asset means, chargeable disposal means, and chargeable person means. So the first topic is chargeable person. Chargeable person includes individuals and companies. So the CGT, the capital gain tax, will arise on a chargeable person. Chargeable person will include individuals and companies. In these CGT chapters, we are concerned with disposal by individuals. The first 4 chapters will cover the CGT disposal by individuals. Individuals who are UK resident in the tax year in which the disposal take place are subject to CGT capital gain tax on their gains. UK resident individuals are subject to UK CGT on all disposal of chargeable asset regardless of where in the world the assets are situated. So the capital gain tax will be charged on the worldwide gains if the individual is an UK resident in that tax year. Non-UK residents only pay UK CGT on disposal of interest in UK land. However, this is not examinable. This is part of the ATX, the Advanced Taxation paper, students. So, first we covered the scope of CGT. The capital gain tax will arise on chargeable person making chargeable disposal of chargeable asset. So, what does the term chargeable person includes? The term chargeable person includes individuals and companies. So, the individual will pay the corporation tax, the capital gain tax on the gains arising on the worldwide gains. If an individual is a UK resident, then he will be subjected to CGT on disposal of chargeable asset regardless of where they are situated in the world. I hope this is clear. Now, coming to the term of chargeable disposal, students. As we have seen, chargeable person means individuals and companies. If a person is a UK resident, then he will be subjected to the UK CGT on disposal of all chargeable asset regardless of whether in the world the assets are situated. Where the asset is situated, the person is a UK resident, he will be taxed on all the disposal of the chargeable asset. Now moving to chargeable disposal. Chargeable disposal includes sale or gift of the whole or part of the asset. If we are selling or gifting a asset, will come under the chargeable disposal. Either we gift, either we sell a part of the asset, it will known as chargeable disposal. Exchange of an asset. If we exchange an asset, it will also be covered under the chargeable disposal. Loss or total destruction of an asset. If the asset has been destroyed or some damage has been caused or we have lost the asset, then this will also be known as chargeable disposal. Chargeable disposal means the disposal must be chargeable. It must be chargeable under the CGT. Receipt of capital sum derived from an asset, for example, compensation received for damage to an asset, receipts for the surrender of right to an asset. So students, if we receive a capital amount, that is like if we receive any compensation amount on the damages of the asset from the insurance company, if our asset has been damaged and we receive insurance from the insurance provider, as we have already done the insurance for that asset, then the amount of insurance or the compensation which is paid by the insurance company will be included in the chargeable disposal. It will, the capital gain tax will arise. Then receipts for the surrender of right to an asset. The receipts which we receive by surrendering the rights to an asset. The rights of an asset are surrendered to other person and they are paying us a receipt. So chargeable disposal means, students, either we are selling or gifting a part of the asset. If we exchange a asset, it will be dealt under CGT and the CGT tax will be applicable. Loss or total destruction of an asset. Receipts of capital sum derived from an asset such as the insurance compensation for the damage of the goods, or receipts which are surrendered because of the rights, receipts which a person receives for surrendering the rights of an asset. Then these are the chargeable disposal. Now coming to the exempt disposal, the disposal which are exempt from CGT. Disposal as a result of death of an individual, gifts to charities. Disposal as a result of the death of an individual. So students, if the assets are sold when a person dies or it has been transferred, it will be exempt from CGT. This will be covering under the IHT. And gifts to charities. If we are gifting some assets or some amount of money to the charity, it will be exempt. Gifts to charity. The gifts, if we are paying in cash, we have already covered it. If we are gifting some assets, it will come under the CGT and it will be exempt. As we have already seen, sale or gift of the whole or part of the asset is chargeable disposal, but gift to charity, it is exempt, student. And disposal as a result of death of an individual, it will be exempt from CGT. And when we transfer assets, students, on the death of an individual to his son, to his family members, it will be exempt and it will be covered under the IHT, inheritance tax. We will be covering in more detail the inheritance tax. But the exempt disposals are gift to charities and transfer of assets on death, that is a disposal as a result of death of an individual. Disposal means either sale or gift. I hope this is clear, students. Disposal as a result of the death of an individual. Then moving to the chargeable assets. Chargeable assets and exempt assets. If the capital gain tax will only arise if, students, that is a chargeable disposal of chargeable asset by a chargeable person. 3 also condition needs to be satisfied so that CGT will apply. All forms of capital assets, whether situated, are chargeable assets. Whether it is situated in the world wherever in the world it will be subjected to CGT. I hope this is clear, students. Now coming to common examples of C, the chargeable assets. Freehold land and building. So land and building, goodwill, unquoted shares, quoted shares, certain types of chattels will be covering in chapter number 18. Chattels are tangible movable assets, example furniture, plant and machine. So chattels are, students, tangible movable assets. So the chattels are tangible movable assets. So these are the examples for chargeable assets. The freehold land and building, goodwill, unquoted shares, quoted shares, certain types of chattels, which will be covering under the chapter number 18 more detail. So the basic definition of chattel is, students, chattel are tangible and movable asset. The asset is movable and tangible. We can feel or touch it. I hope this is clear, students. Now moving to the list of exempt assets. Exempt assets include motor vehicles, including vintage cars, main residence, cash, certain types of chattel will be covering under the chapter number 18. Investment held within an ISA account. This we have already covered in our starting chapters. Qualifying corporate bonds are exempt from CGT. Gilt-edged securities, NSI certificates, the National Saving Investment Certificates, foreign currency for private use, receivables, trading inventory, prizes and betting winnings. So these are the list of exempt assets, which include, students, motor car, main residence, cash, certain types of chattels, investment held with an ISA account, qualifying corporate bonds, gilt-edged securities, NSI account, the certificate, NSI certificates, foreign currency for private use, receivables, trading inventory, prizes and betting winnings. So these will be exempt from the CGT. If we are selling a main residence, that it will be an exempt asset. For main residence, we have certain rules we will be covering in more detail in our coming chapters. I hope this is clear, students. The differences between the chargeable asset and the exempt asset, students. The chargeable asset and the exempt asset. Chargeable asset and the exempt asset. I hope this is clear, students. Now we will look to, as we have seen, students, the scope of capital gain tax. Capital gain tax is charged on gains arising on chargeable person making chargeable disposal of a chargeable asset. Now, students, what does the term chargeable persons means? So, students, as we have already seen, chargeable persons will include companies and individuals. So, students, we have also seen a person, an individual who are UK residents in the tax year in which the disposal takes place are subject to CGT tax on their gains. So, UK resident individual, students, if a person is a UK resident individual, UK resident individuals are subject to UK CGT on all disposals of chargeable assets regardless of where in the world the assets are situated. assets are situated. I hope this is clear, students. If a person is a UK resident, then the individual will be subjected to UK CGT on all disposal of chargeable asset, regardless of where the asset in the world is. I hope this is clear. So, this is the third point, students. We will mention one more point so that it will be clear. So, if individuals who are UK resident in the tax year in which disposal will take place, are subject to capital gain tax. So students, chargeable person means companies and individuals. So and individual who are UK residents in the tax year in which disposal takes place are subjected to CGT. If a person is a UK resident, then he will pay CGT on all the worldwide gains wherever the asset is in the world, and if he has sold the asset, then the CGT will be charged on the asset wherever the asset is situated in the world. Whether the person is a UK resident and he has an asset in America or US, if he sells it, the CGT will be applicable because he is a UK resident. And students, how we will determine whether the person is a UK resident? We have already covered this in the chapter number 2. So the resident status of an individual. So we will be mentioning a point here, students. Residence status of an individual. Residence status of an individual for capital gains tax is same as for income tax. We have already covered this, students. The 3 types of test. The resident status of an individual for capital gain tax is the same for income tax. Purpose. This we have already covered in our chapter number 2 and 3, students. The resident status of an individual. If the individual is a UK resident, then he will be subjected to CGT for the disposal in the tax year wherever the assets are situated in the world. I hope this is clear. Now students, moving to chargeable disposal. So what does the term chargeable disposal means? Chargeable disposal means, as we have already covered, students, chargeable disposal, we have 2 types. One known as the chargeable disposal, or some type of the disposal will be exempt. Chargeable disposal and exempt disposal. I hope this is clear. Now under the chargeable disposal, it will include, students, sale or gift of an asset. If we sell or gift an asset, it will be a chargeable disposal. Sale or gift of an asset. Then exchange of an asset. The third one, loss or destruction of an asset. Loss or total destruction, that the asset has been damaged. Loss or destruction of an asset. The fourth we covered is the receipts of a capital sum. This we have taken the example known as, students, the receipt of a capital sum derived from an asset. Students, from an asset. The asset must be a chargeable asset. So we have taken the examples like the insurance compensation for the damage of assets. Then students, we had seen rights, receipts for the surrender of the rights. I hope this is clear. So the chargeable disposal means sale or gift of the asset, destruction or loss of the asset, exchange of an asset, and receipt of capital sum which we receive from an asset. Includes the insurance compensation if our asset has been damaged, and the insurance we are being paying, and we can claim the insurance amount, and the amount or the capital sum received by surrendering the rights of an asset. The exempt disposal will include, students, the most important. The exempt disposals are the first one, gifts to charity. Students, as we have seen, gift of an asset, it will be chargeable disposal, but gift of an asset to charity, it will be exempt. Students, it will be exempt. Then the second exempt disposal is disposal as a result of, students, disposal as a result of the death of an individual. I hope this is clear, students. If, students, there is a sale of an asset, it will be CGT. And if it is gift of an asset, but if the gift of an asset is during the individual is alive, if the person is alive and he is gifting it, it will be applicable for CGT. If a person, there is a disposal means sale or gift, both, students. So disposal means gift as a result of the death of an individual will be a exempt disposal. Students. I hope this is clear. So students, many of the students will have a confusion between the CGT and IST. We will be drawing a flow chart after this. This we have covered the chargeable disposal, students. Chargeable disposal, if the disposal is, students, if the disposal is in the result of the death of an individual, it will be an exempt disposal. This will be covering under the IHT. Then coming to the next topic known as chargeable assets. Students. Chargeable assets. So chargeable assets will include, students, here also chargeable assets, and then coming to the case of exempt assets. Students. Chargeable asset and exempt assets. So chargeable assets will include, students, freehold land and building. Students. Then second one will include goodwill. Goodwill is also chargeable asset. Then quoted shares, the shares of listed companies. Quoted means listed company shares. Unquoted shares of unlisted companies will also be subjected to CGT if they are disposed of. Then certain chattels, we will be covering this in a chapter number 18 in more detail, and these are the list of chargeable assets. Then students, the list of exempt assets. Students, exempt asset will include motor cars. Then we have seen the gilt-edged securities. Then the assets are qualifying corporate bonds, qualifying corporate bonds, QCD, QC, the qualifying corporate bonds QCB, and then currency for personal use, the foreign currency for personal use. Then we have seen the certain types of asset. The certain types of assets will include wasting chattels. This will be covering students. What does the term wasting chattel means in our chapter number 18? Then the national saving certificate, national saving certificates are also are exempt assets. Then students, the investment held in the individual saving account, investment held in ISA account, individual saving account. Then the awards, medals awarded for bravery are also exempt to bravery, or inherited are exempt. But if the awards are purchased, then it will be taxed. Not purchased means the government has provided some awards, so the awards we can sell it, but it will not come under the capital gain tax. If we have purchased the medal and then we sell it, then it will be under the capital gain tax, students. If we receive any medal from the government for our bravery, then if we sell it, because it will have a value and we can sell it, so it will be exempt from CGT. But we purchase and sell it, it will be charged for capital gain tax. Then coming to the receivables, trading inventory. So these are all trading inventory. These all are, students, current assets. Then we have seen the prizes and betting winnings are also exempt, student. So this is a list of the exempt asset. I hope this is clear, student. This is a list of exempt asset. So students, the exempt asset list needs to be remembered, students. The exempt asset list needs to be learned because students, the question in your examination, the question will contain the exempt asset also as calculation for CGT, but you need to mention that it is an exempt asset, so the CGT will not be applicable. Exempt asset list needs to be learned because the exempt assets will be given in the exam question to calculate the CGT. So exempt asset as the assets are not chargeable, so that is exempt assets, no CGT implication, student. The list of the exempt assets needs to be learned because, students, in the question will comprise of 2 to 3 assets being sold, and in that one of the asset will be exempt, and the question will specify to calculate the CGT. But on the exempt asset, we will not calculate CGT because it is a exempt asset. It is not an chargeable asset, student. The capital gain tax will arise on chargeable disposal of chargeable asset by a chargeable person. I hope the scope of the CGT is clear. The scope of CGT is clear, students. Now moving forward to the calculation part. Calculation of capital gains and loss of on individual disposal. An individual is subjected to CGT on the total taxable gains arising on the disposal of all assets in a tax year. So student, the CGT, the capital gain tax, will be calculated on the total taxable gains arising on the disposal of all assets in a tax year. So all the assets which are disposed in a tax year, and it will give rise to the total taxable gains. On the total taxable gains, the CGT will be calculated for an individual. The following steps are carried out to compute the capital gain tax by an individual for a tax year. So these are the 5 important steps, students, we need to follow to calculate the capital gain tax. So the capital gain tax will be calculated on the total taxable gains arising on the disposal of all assets in a tax year, students. I hope this is clear. Now coming to the calculation of capital gains tax. So students, as we have seen, capital gains tax, the capital gain tax let's mention here, students, an individual is subject to the capital gain tax on total taxable gains arising on all disposals on the disposals of all assets in a tax year. So students, the individual will be subjected to CGT on the total taxable gains arising on the disposal of all assets in a tax year. First, students, we need to understand the scope. As we have seen, the capital gain tax will arise on disposal of chargeable asset by chargeable person. If a chargeable person disposes a chargeable asset, if a chargeable person disposes of a chargeable if a chargeable person makes a chargeable disposal of a chargeable asset, then the capital gain tax will be applied. And now we are studying the calculation of capital gain tax. The capital gain tax will be calculated on the total taxable gains. If in an tax year, if an individual is selling 2 or 3 assets, then the total of the gains, we need to calculate it, the total gains, and that total gains will be subject to the capital gain tax. Now students, we have to see the 5 steps which we need to follow to calculate the capital gain tax. The step 1, calculate the chargeable gains or allowable loss arising on disposal of each asset separately. So students, the first step is to calculate the chargeable gain or allowable loss on each individual asset, for each disposal of each chargeable asset separately. Then calculate the net chargeable gains arising in the tax year, that is chargeable gains less allowable loss. So we need to calculate the net chargeable gains. First step is to calculate the chargeable gains or allowable loss for each individual chargeable asset. Then the second step is to calculate the net chargeable gains, the total of all the gains or losses in the tax year. Then we need to deduct the AEA. This is known as annual exempt amount. So this amount is, students, same as a PA. In our income tax calculation, we had PA on which no income tax, and it will be exempt. This certain amount will be exempt from income tax calculation. Same, we have a AEA for capital gain tax. On this amount, no capital gain tax will be calculated, known as AEA, annual exempt amount. The annual exempt amount means the amount on which the CGT is exempt, no calculation of CGT. Deduct capital loss brought forward will give rise to the taxable gains. So we need to deduct the capital loss, students, which has been brought forward, then we will arrive to our taxable gains. Then the step number 5, calculate the CGT payable for the tax year. So this is the approach we need to follow to calculate the capital gain tax. The first step will be to calculate the chargeable gains for each chargeable asset separately, then calculate the net chargeable gains arising in the tax year, that is chargeable gains less allowable loss. Then the third step is, students, deduct the annual exempt amount, then deduct capital loss brought forward, then we need to calculate the capital gains tax payable for the tax year. Students, when we were doing the losses for individual chapters, we have already covered the format: the capital gains less capital loss less trade loss set off relief less AEA less brought forward loss. So the same format we will be seeing here also. So students, we need to calculation of CGT, we need to follow a approach. We need to follow step by step approach. So the step 1 will be, students, so following steps needs to be followed to calculate capital gains tax. The step 1, students, is the step number 1 is calculate chargeable gains. Calculate chargeable gains or allowable loss arising on the disposal of each chargeable asset separately, student. Each chargeable asset separately. So first we need to calculate the chargeable gains for each asset separately. Now moving to the step number 2. So step number 2, students, we need to calculate the net. We need to calculate the net chargeable gains. The net chargeable gain means we need to combine the gains and loss of all the assets which has been disposed in the year. Calculate the net gains arising in the tax year. I hope this is clear, students. Then this will be, students, chargeable gains less allowable loss. I hope this is. Then the step number 3, students, the step number 3 is to deduct the annual exempt amount. The step number 3 is deduct annual exempt amount, known as annual exempt amount. This is an amount on which the CGT will not be calculated, same as a personal allowance. The annual exempt amount for FY 23, it is, students, 6,000 pounds. We will be covering 6,000 pounds. Then coming to the step number 4, students. The step number 4 was to deduct capital loss brought forward. Deduct capital loss brought forward. Each step will be covering in more detail, students. This is the approach which we need to follow in order to calculate it. So we will arrive to our taxable gains. we will arrive to our taxable gain. After deducting the capital loss brought forward, we will arrive to our taxable gains. And the step number 5 is, students, calculate the CGT payable. Calculate the capital gains tax payable. I hope this is clear. So this is the approach we need to follow in order to calculate the capital gain tax. Now we will be covering each step in detail, students. So we will be covering each step in detail. We will be covering each step in a detailed manner. So now coming to the step number 1. This is the format for calculating the disposal or the chargeable gains or allowable loss for the each chargeable asset. So step number 1, for each disposal by an individual, calculate the chargeable gains and allowable loss as follows. This format you need to learn, students. This you need to learn so that we can calculate the chargeable gains or allowable loss for each individual chargeable asset. So first, disposal proceeds. So what does the term disposal proceeds means? We are disposing of the assets and we are receiving money. So the amount or the money which we receive by disposing of the asset. The disposal means, students, chargeable disposal. As we have seen, chargeable disposal includes gift or sale of an asset. If we are selling an asset, we will receive some amount. This will be known as disposal proceeds. If we gift an asset, we will be seeing what will be the amount. What we need to consider for the disposal proceeds. Less allowable selling cost. The selling cost which we have incurred will be reduced. So disposal proceeds less allowable selling cost. The selling cost needs to be reduced. I hope this is clear. Whatever cost we have incurred to sell the asset, we can deduct it from the disposal proceeds. So from if we deduct the allowable selling cost, we will arrive to a net disposal proceeds. Then from the net disposal proceeds, we will reduce the allowable expenditure. So the allowable expenditure will include cost of acquisition, the cost which we have incurred in order to acquire the asset. If we are selling an asset, students, first we need to calculate the chargeable gains for each asset. So chargeable gains, the format for calculating the chargeable gains or loss will be, students, first we will dispose and we will receive the disposal proceeds less the selling cost which we have incurred in order to sell the asset. We will arrive to a net disposal proceeds. Then we need to reduce allowable expenditure. Allowable expenditure will include cost of acquisition, the cost which we have incurred in order to acquire the asset. Then incidental cost of acquisition. Incidental cost means the cost which we incurred when we acquired the asset. Then additional capital enhancement expenditure. If further capital improvements have been done, then that also will be included. So the total will be allowable deduction, and this, after deducting the allowable expenditure, we will arrive to our chargeable gains and allowable losses. We will arrive to our chargeable gains and either chargeable gain or loss. I hope this format is clear. The step number 1, in order to calculate the chargeable gain or loss for each individual chargeable asset. First, we need to consider the disposal proceeds which we receive. Then less selling cost, allowable selling cost. We will arrive to a net disposal proceeds. Then we need to reduce the cost. So the cost will be cost of the acquisition, incidental cost of acquisition, and additional capital enhancement cost. So after deducting it, we will arrive to the chargeable gains or allowable loss. Students, whenever we need to calculate a gain, how we will calculate the gain? When we need to calculate the gain or the profit on an asset we sold, simply or the simple approach will be, students, first we will take the amount which we receive, sale amount, the amount which is the sale proceed, let's the cost which we have incurred. So this will give rise to the gains. But here we are covering in more detail what does the sale proceeds, what will the sale proceeds includes, what are the costs which are allowed or disallowed. I hope the format is clear. Now we will be covering in detail the net disposal proceeds. For the calculation of net disposal proceeds, what are the important points we need to consider? The net disposal proceeds used in the computation, the disposal proceeds used in the computation is normally the sale proceeds, is it? The sale proceeds which we receive by selling the asset will be the disposal proceeds. Incidental costs arising on the disposal are deducted from the gross proceeds, like the auctioneer fees, estate agent fees. Like if we are paying a agent the fees to sell the asset, this will be deducted. Then, however, market value is substituted for the actual gross proceed received. So students, the market value is substituted for actual gross proceed received. So if we will sell an asset, we will receive an amount. So that amount will be known as sale proceed or the disposal proceeds. But students, in certain cases, we need to use the market value. We need to use the market value for the disposal proceeds. So the deal was not at arm's length transaction. Example, gift. If we are gifting an asset, we will not receive any sale proceeds. So in that case, the disposal proceeds will be, students, in that case, the disposal proceeds will be the market value of that asset on the date of disposal. The law assumes that it was not made at arm's length. Example, transfer between connected parties. So arm's length means, students, it was not done at the market rate. If the market rate was 200,000 pounds and we have sold the asset only for 50,000 pounds, this means the transaction was not done at arm's length. So the transaction was not at arm's length. So students, the disposal proceeds, the term disposal proceeds means the sale proceeds which we receive from selling the asset, and we will deduct the cost which we have incurred in order to sell the asset. Students, but if we gift an asset, we will not receive any amount, we will not receive any proceeds. So in that case, when we gift an asset, we need to consider the market value. We need to consider the market value of the asset. And if the disposal is not at the arm's length transaction, that is, the disposal has been done to the connected parties. So connected parties means, students, at ATX, an individual is connected with close relatives, that is parents, siblings and children. So if the asset has been sold to connected parties and the transaction is at not an arm's length, then we need to consider the market value. I hope these 3 points are important, students. In the question, they will specify whether the asset has been disposed for the sale proceeds. If the question specifies that the asset has been gifted, then they will not provide the sale proceeds, students. We need to consider the market value. And in some cases, the transaction will not be done at the arm's length, then we need to consider the market value. If we are selling the asset to our connected parties, example, parents or sibling or children, at a lower amount, then we need not consider the lower amount. We need to consider the market value of the asset. So students, now coming to the detail, step number 1. The step number 1 was the calculation of chargeable gains or loss for each. Step 1 was, students, chargeable gain or allowable loss for each chargeable asset. So the first step was to calculation. So now the format will be, students, disposal proceeds less incidental, or simple words will write as allowable selling cost. Allowable selling cost, students. So disposal proceeds less this, we will arrive to our net disposal proceeds. We'll arrive to our net disposal proceeds. Then students, we will less allowable expenditure. Allowable expenditure. So allow expenditure includes students. The first one was the cost of acquisition. The cost of acquisition of the asset, student. The cost of acquisition. Then the incidental cost of acquisition, the cost which we have incurred in order to acquire the asset. Incidental cost of acquisition. Then third one was the additional capital improvements or additional capital expenditure. So this total we will reduce such that we will arrive to our chargeable. We will arrive to our chargeable gain or loss, students. Chargeable gain or loss. This is the most important format, students. And now we will see what does the term, how to calculate the or the calculation which involves the disposal proceeds. So students, as we have seen, first point, disposal proceeds. See, the disposal proceeds means, students, disposal proceed means sale proceeds received. Sale proceeds received. Sale proceed received. I hope this is clear. And the allowable, the students, allowable selling cost will include, students, the cost which we have incurred in order to sell the asset. This will include the incidental selling cost. Example, agent fees or auction fees. The auction, for the auction we have paid some fees. This will be known as selling. These are the example for the auctioneer's fees. Then students, we have seen the most important point. Note, in the calculation of the disposal proceeds, we have seen market value of the asset will be substituted for actual gross proceeds, students. For the actual gross proceeds. And that where, students, it will be in which case, students? The first one is, that is the market value of the asset will be substituted for actual gross proceeds, where the transaction is not made at arm's length. Students. Now the example includes, this will include, students, gift of an asset. The arm's length examples are gift of an asset and transfer between connected parties. Connected parties means, students, parents, siblings, and children. This is for tax purpose. But when coming under the ATX, we have more detail what does the term connected party means. So students, we have seen the calculation for the step 1 will include the disposal proceeds less allowable selling cost. We will arrive to our net disposal proceeds. Then we will reduce the allowable expenditure, the cost of acquisition, incidental cost of acquisition, and additional capital expenditure. This will give rise to the chargeable gain or loss. So now coming to the first important most topic, the disposal proceeds. Disposal proceeds means the sale proceeds received. But an allowable selling cost will include incidental selling cost like agent fees and auctioneer's fees. The auction, if we are paying the fees for the person who is auctioning our asset. Then the most important note is that students, the market value of the asset will be substituted for actual gross proceeds. In which case, student, where the transactions are not made, at the arm's length. Arm's length means, students, not done at the market value. So arm's length examples are when we gift an asset or transfer between connected parties. So arm's length means, students, the asset is sold at market value. So if the transaction, where the transaction is not made at arm's length means the asset is not sold at market value. If the asset arm's length means it is sold at market value, not at arm's length means the asset has not been sold at the market value. So the disposal proceed will be the market value, and arm's length will occur when, students, when we gift an asset or we transfer between the connected parties at a lower amount. Transfer between connected parties at a lower amount because it is not an arm's length transaction. I hope this is clear, students. Now we will be seeing what are the allowable expenditure. Allowable expenditure. The type of expenditure that rank as allowable deduction are the cost of acquisition, that is the purchase cost, expenditure on enhancing the value of the asset, improvement expenditure, expenditure incurred to establish, preserve or defend the taxpayer title to the asset. If the expenditure has been incurred in order to defend the taxpayer title of the asset, this also will be included in the allowable expenditure. Incidental cost arising on the acquisition of the asset. So these are the 4 costs which are allowed. I hope this is clear. Now the important note here is, students, where an individual acquires an asset as a gift. If I am acquiring the asset as a gift, then what will be my cost? Or from a sale of less than market value, the cost of acquisition will be the market value of the asset at the date of the gift. So the cost of acquisition will be the market value of the asset at the date of the gift or sale at undervaluation. Where an individual inherits an asset on death, the cost of acquisition will be market value of the asset at the date of death, that is probate value. Now students, we have seen in the format less allowable expenditure. Allowable expenditure will include cost of acquisition, incidental cost of acquisition and capital expenditure which the individual has done before selling the asset. And if expenditure which have been incurred by the taxpayer to defend the title of the asset, this will also be an allowable expenditure. But students, when coming to the case when an individual acquires an asset in the form of a gift, let's take an example of an individual A and B. So A is gifting an asset. So if he gifts an asset, it will be the CGT will be applicable to him. The CGT for A will be applicable. So if he gifts an asset, the CGT, the disposal proceeds will be the market value. So the disposal proceeds will be the market value. But students, when B will sell it, then his cost will be, because when he will sell it, the disposal proceeds will be the sale proceed which he received. But the cost for the B, what will be? The cost for the B will be the market value when the asset was gifted to B. Market value when the asset was gifted to B. If an individual inherits an asset, means if he inherits from his ancestor, means he receives the assets from his father or his ancestors or his grandparents on the death. If an individual receives an asset or inherits. Inherit means, students, the individual will receive the asset on the death of his ancestors, his father, his grandfather, or etc. Then in that case, when B will sell it, the cost will be for him. The cost, the acquisition cost will be the market value of the asset at the date of the death. That is known as probate value. The probate value will be used when the asset is inherited. When an individual inherits an asset on death. But so this will be the cost of acquisition. But students, if the asset has been made as a gift during the lifetime and the person will sell it, the cost of acquisition will be the market value of the asset at the date of the gift or sale at undervaluation. I hope this is clear. Now students, we need to see, now coming to allowable expenditure. The allowable expenditures. Allowable expenditure. So students, the allowable expenditure will include the cost of acquisition, that is the purchase cost, the second will be the incidental cost of acquisition, as we have seen, incidental cost of acquisition. Then the allowable expenditure will also include, students, the capital, allowable capital expenditure, and students, the expenditure incurred by an individual, expenditure incurred to establish, preserve, or defend the taxpayer title of the asset. So these are the allowed expenditure to the asset. So students, the capital expenditure will be allowed. Revenue expenditure, it will be allowed, students? No, students. Note, revenue expenditure like the repair and maintenance will be excluded. It will not include. I hope this is clear, students. Now coming to a most important case, student, here in our example. Here we'll be taking a most important case. Where, note here, important note, students, where an individual acquires an asset on gift, or from a sale for less than market value, so in that case, students, the cost of acquisition will be, students, the cost of acquisition will be the market value of the asset at the date of the gift of the asset. So whenever person at the date of the gift of the asset. I hope this is clear, students. Let's take an example here, students. So students, Let's take A gifted asset to B. Both are individual. Gifted asset to B. So A gifted an asset to B and B sells the asset. B sell the asset. If B will sell the asset, students, capital gain tax will be applicable. So capital gain tax, then in this case, students, the capital gain tax will be applicable. The disposal proceeds will be the amount which he receives. So for B, the cost of acquisition will be, students, the cost of acquisition will be the market value of the asset when for B the cost of acquisition will be the market value of the asset when gifted by A, when it was gifted by A. So on the date for B, because B will sell it, for B the cost of acquisition will be the market value of the asset when it was gifted by A. I hope this is clear. Now coming, students, where an individual inherits an asset. Inherits an asset on death. So students, the cost of acquisition will be the market value on the it will be, students, market value of the asset at the date of the death of the individual. So it will be known as probate value. This all data will be provided, students. Only we need to follow the approach. Disposal proceeds less selling cost will give rise to the net proceeds, then less allowable deduction, cost of acquisition, less incidental cost of acquisition, less capital improvement. So now we have studied what is the cost of acquisition will be. If a person will acquire an asset as of a gift, it will be market value of the asset at the date of the gift, and the cost of acquisition will be the market value of the asset at the date of the death when an individual inherits an asset. I hope this is clear, students. If a person inherits an asset, means he will receive this asset from his father or ancestors. He will receive the asset. He will not pay anything. So the cost of acquisition will be the market value of the asset at the date of death. I hope this is clear, student. Do not confuse between the transfer of an asset on the death. If the person is transferring, students, let's take an example. Here, same A to B. B is selling the asset, so CGT will be applicable. B receives the asset. The asset is inherited, students. The asset is inherited. So then the cost for acquisition will be, students, inherited. The cost for B will be market value of the asset at the date of the death. So but students, A dies. Let's take A dies and all the assets are inherited to B. A is father, B is son. So father dies and son is alive. So the father assets will be inherited. all the assets which are in the name of the father will go to the son. All the assets which remains with the father will be transferred to the son. So in that case, students, when the father, the assets which are transferred on the death, when he dies, whether CGT will be applicable for A? No, students, CGT will not be applicable. It will be covered under inheritance tax. CGT, no. IHT will be charged. I hope this is clear. So, but when B has received all the assets he has inherited from his father on the death, so then the cost for B will be when he sells. If B sells it, it will be a capital gain tax for B. If B sells, it will be capital gain tax. So the cost for the B will be the market value of the asset at the date of the death of A. I hope this is clear. The cost of acquisition. So students, till now we have covered the step number 1. The format we have seen. We have seen the format. We have seen the format, students. Till now we have seen the format. That is disposal proceeds. The step number 1, disposal proceeds less allowable cost will give rise to the net disposal proceeds less allowable expenditure. Allowable expenditure will include the cost of acquisition, incidental cost of acquisition, additional capital expenditure. So this will give rise to the chargeable gain or loss. Then coming to the disposal proceeds. Disposal proceeds will include, students, the disposal proceeds will include sale proceeds received and the allowable selling cost. From the disposal proceeds, we will deduct the allowable selling cost, and allowable selling cost will include the incidental selling cost. Incidental selling cost are examples are the auction, the agent fees and auctioneer fees if we are paying any amount for the auction. Then the most important note is that, students, market value of the asset will be substituted for the actual gross proceeds. For the sale proceeds, students, we will take market value when the transaction is when the transaction is not made at arm's length. Arm's length means the asset is sold at market value. If the asset is not sold at market value, then we will consider the market value for the disposal proceeds. Example, gift of an asset and transfer between connected parties. So in this case, the transaction will not be at arm's length. So in that case, the disposal proceeds will be, students, the market value at the date of the sale. Then coming to the allowable expenditure. Allowable expenditures will include, students, the cost of acquisition, that is the purchase cost. Then incidental cost of acquisition. Incidental cost of acquisition will include, students, the cost which we have incurred. Cost incurred to acquire the asset. Allowable capital expenditure. Expenditure incurred to establish, preserve or defend the taxpayer title to the asset. So if we are incurring the expenditure to defend the title of the asset, will also be included. But important note is that, students, revenue expenditure like repair and maintenance will be excluded from the allowable expenditure. Then where an individual acquires an asset on gift, if the asset is acquired as a gift and that person sells it, then the cost of acquisition will be, students, market value of the asset at the date of the gift of the asset, as we have taken an example here already. Now coming to the second important one, where an individual inherits the asset, students. Where an individual will inherit means he receives the asset from his ancestors on their death. Then in that case, the cost will be for the cost for the person will be market value of the asset at the date of the death of the individual. That means it is the probate value. This you need to keep in mind, students. Asset at the date of death of an of the individual, students. I hope this is clear. Here it will be probate value. It will be known as, this will be provided in the question, students. Then this till now here we have covered. Now students, we will be doing a question so that we have a better understanding. Calculation of net chargeable gains. Calculation of net chargeable gains. S sold an antique vase for 12,000 pounds. So S sold an antique vase for 12,000 pounds and a painting for 20,000 pounds. So students, we have seen the step number 1 was calculate the chargeable gains or allowable loss on disposal of each asset separately. Then the step 2 was calculate the net chargeable gains, that is chargeable gains less allowable loss of the total assets which have been disposed in the tax year. Now the step number 2. Step 2 was students. The step 2 was students calculate the calculate the net chargeable gains. Means we need to add all the chargeable gains or loss so that we arrive to our net figure. Chargeable gains. Calculate the net chargeable gains arising in the tax year. So this will be the total of all the chargeable gains. It will be chargeable gains of all the asset disposed in the tax year less allowable loss. If we have an asset has been sold for loss, it will be less allowable loss. Less allowable loss. Allowable loss. I hope this is clear, students. S Limited, so S sold an antique vase for 12,000 pounds, okay, and a painting for 200,000 during the tax year. He incurred auctioneer fees of 1% of the proceed. He acquired the asset for 13,000 and 7,000 respectively. Calculate the net chargeable gain arising. So students, this, as it is the CGT, the capital gain tax will be arise if capital gain tax will arise, students, when there is a chargeable disposal of chargeable asset by a chargeable person. Here we need to assume that all the 3 conditions are satisfied. So the first case, we need to calculate the chargeable gains for each individual, for each chargeable asset separately. So first, antique vase. So students, here he has purchased the asset. So the first step number 1 was to follow the format to calculate the chargeable gains or allowable loss for each chargeable asset. So the first is disposal proceeds. The disposal proceeds will be equal to the disposal proceeds, students. As we have sold it, so it will be 12,000. I hope this is clear. If the transaction was not at arm's length, then we will use the market value. Arm's length if it is gifted or the asset has been, if the asset has been gifted or it has been transferred to connected parties. In that case, we'll use the market value. But here it is clearly mentioned it is sold for 12,000. So less allowable selling cost. As they are mentioned, students, he incurred auctioneer fees of 1% of the proceeds. So the proceeds is 12,000 into 1%. This will be, students, 120. So this will give rise to our, students, this will give rise to net proceeds. So our net proceeds will be, students, 11,880. I hope this is clear. Then less allowable expenditure. This is the step number 1, students. Allowable expenditure, the cost of acquisition. The cost of acquisition they have mentioned, students, he acquired the asset for 13,000. So it was acquired for 13,000, and no other allowable expenditure is given, like the capital expenditure or any expenditure incurred to save the title of the asset or to preserve the title of the asset, and no other allowable expenditure is given. So it will give rise to R. So this will give rise to the, as it is in this 11,880 and we acquired the cost of, so this will be, students, 1120 of negative number. So this will be allowable loss. I hope this is clear. But we need to calculate the net chargeable gains. But students, we have other asset. So first we need to calculate the chargeable gains or allowable loss for each individual asset. Now coming to the second asset, which is painting. So painting, the disposal proceed DP will be, students, I am writing the short form, but you need to write the full word in the examination. So disposal proceed will be 20,000 pounds less allowable expenditure, allowable selling cost. It will be 1% of the proceed, student, into 1%. This will be 200. So our net disposal proceeds is, students, 19,800 less allowable expenditure. So cost of acquisition is only given, students. So this will be 7,000. This will be 12,800. This will be our chargeable gains. I hope this calculation there. And now, students, the step number 2, calculate the net chargeable gains. The net chargeable gains will be, students, net chargeable gains will be, students, the net chargeable gains will be, chargeable gains 12,800 less allowable loss. The allowable loss is 1120, students, 1120. So this will be our net chargeable gain. 11,680 is our net chargeable gains. I hope this is clear. We have completed the step number 1 and step number 2. Step number 2 is simple, students. We need to aggregate the total gains and loss of the current year. Now moving to a further question. We will be doing one more question, students. On 1st August 2023, M sold a holiday villa for her sister. So M sold a holiday villa to her sister. So it was to her sister 25,000. Its market value at the date was 100,000 pounds. M acquired the villa on 1st June 2007 for 20,000 and paid legal fees on acquisition of 500 pounds. On 1st May 2012, she had added a conservatory cost at a cost of 10,000. So she had added a conservatory at a cost of 10,000, means an capital expenditure has been done. Calculate the chargeable gains arising on the sale of villa. So here it is only the step number 1 on the each individual asset. So students, it will be, we need to calculate, as M is selling it, M is sold to her sister. So M is an individual, chargeable person, chargeable disposal. As it is sold, it is sale, so it will be a chargeable disposal. And chargeable asset, as it is a villa, it will be a chargeable asset, students. As it is a villa, it will be a chargeable asset, students. It will be a chargeable asset. As it is a freehold land and building, it will be a chargeable asset. So disposal proceeds will be, students, disposal proceed will be the amount which he received. But yeah, we have received 25,000. But students, the disposal has been done to sister and the market value was 100,000 pounds. So we are selling it for 25,000, but the market value is 100,000 pound. This is not an arm's length transaction. This is not an arm's length transaction. Please do remember, students, here we have already seen it. We have already seen it, students, here. Whenever the disposal market value of the asset will be substituted for actual gross proceeds where the transaction is not made at the arm's length when the gift of an asset or transfer between connected parties. So as in our example, students, it is a connected party, so the disposal proceed will be the market value at the date of the transfer. So less allowable selling cost. So they have not mentioned any cost here, students. Then we will arrive to a net proceeds, net disposal proceeds. Net disposal proceeds, it will be 100,000 pounds less allowable expenditure. So the allowed expenditure will be, students, cost of acquisition. So the cost of acquisition was 20,000. M had acquired this in 2007. Then the incidental cost of acquisition, the cost of acquisition we have, and the cost, the additional cost which we have incurred for the purchase was 500. Then students, we will less, she added, and less any capital expenditure, less capital expenditure, as it is mentioned, it is she had added a conservatory at a cost of 10,000 pounds. So this we will arrive to an answer. This will be, students, 100,000 pounds less 20,000 pounds less 500 pounds less 10,000 pounds. So it will be 69,500. This will be the chargeable gain, student. This will be the chargeable gains. I hope this is clear. This will be the chargeable gain, students. This will be, students, the chargeable gains. Now students, as we have seen the calculation for step number 1 and the format and everything we have covered, disposal proceeds, net selling cost, then net proceeds, then allowable expenditures, then we will arrive to a chargeable gains or allowable loss. And we have seen for disposal proceeds, market value will be used when the transaction is not at the arm's length. It is when it is gifted and transferred between the connected parties at lower than the market value. So the market value will be substituted in the disposal proceeds on the date of the sale. Then we had seen the allowed expenditure. These are the 4 expenditure which are allowed, and the cost of acquisition when the asset has been acquired as a gift. It will be market value of the asset at the date of the gift, and if it is inherited, students, the cost of acquisition will be the market value of the asset at the date of the death. That is the probate value. When an individual inherits the asset on the death of the person, then the cost of acquisition for the individual will be the market value on the date of the death of the individual. Now moving to the calculation of CGT, the capital gain tax payable. So students, now we'll be seeing the format. The step number 1 was the calculation of chargeable. The step number 1 was the calculation of capital gains or chargeable gains or allowable loss for each separate individual. Then we need to net the chargeable gains. Then we need to net the chargeable gains for the tax year. So the step number 2 was the net chargeable gains less allowable loss. I hope. Then this third step was, students, less AEA. So an individual pays capital gain tax on the total taxable gains arising on the disposal of all asset in the tax year. As we have seen, the capital gain tax will be paid by the individual on the total taxable gains. The following pro forma covers step 3 to 5 in the procedure to calculate the CGT payable by an individual. This will cover the Three steps, students. 3, 4 and 5. Now, pro forma capital gain tax payable computation 2023-24. Net chargeable gains for the tax year. This we have already calculated in the step number 2, step number 1 and step number 2. This figure we need to. And the step number 3 was, students, annual exempt amount. And the annual exempt amount for Finance Act 23 is 6,000 pounds. This is the amount on which we will not be paying the capital gain tax. Same in India. In India also we have, students, the annual exempt amount of 1 lakh. Same in UK also we have an annual exempt amount of 6,000. Same like PA, students. In our income tax calculation we had PA. Here we have AEA. Less capital loss brought forward. The step number 4 was, students, less capital loss brought forward. We'll be covering in later. So this will give rise to the taxable gain. This will give rise to the taxable gains. Then we need to pay the CGT. Though calculate the CGT liability will be, students, taxable gains into appropriate tax rate less payment on account residential property disposal. You will have your CGT payable. This will be covering in our next slide, students. Why we'll reduce the payment on account of residential property? Because the residential property tax CGT implication needs to be paid within 60 days. We'll be covering in more detail. But this, student, this format is very important. This covers the step number 3 to 4. I hope this is clear. So, an individual will pay the corporation tax liability on the total taxable gain arising in the tax year. And we need to follow the approach, students. The step 1 was to calculate the chargeable gains or allowable loss for each chargeable asset. The second step was the calculating the net chargeable gains, that is allowable loss, chargeable gains less allowable loss. The third step was less AEA, that is annual exempt amount of 6,000 pounds. Then less capital loss brought forward. This will give rise to the taxable gains. And the CGT liability will be, students, taxable gains into the appropriate CGT rate less payment on account residential. For residential property we need to pay the CGT early, less that it will give us the CGT payable. I hope this is clear. This format is clear, students. So as we have seen, students, we have covered the step number 1 and 2. Step number 2 we have done. Now coming to step number 3 to 4, students. So the step number 3 was, students, the step number 3 was deduct AEA, that is 6,000 pounds. Then the step number 4 was, students, the step number 4 we have already discussed, reduction of the deduct the capital loss brought forward. Capital loss brought forward. Then the step 5 was calculation of CGT. Calculate CGT payable. I hope this is clear. So now, students, we can follow a format in the examination. This format, the format CGT format. So the format will be, students, the chargeable gain in that year less allowable loss. This will be a, students, net chargeable gains. Net chargeable gains. This is the step 1 and this is the step 2. Then students, we will direct our AEA, annual exempt amount. Here also students, before, please do remember, trade loss set of relief. This we have studied in our the trading loss chapter students. Please do remember. This we have covered there also, the format. Less AEA, then students less. This is the step number 3. Step number 4 students. Less capital loss brought forward. So this will give rise to students. This we will arrive to our taxable gains. Taxable gain students. Then this is the step number, this is not the step number, capital loss brought forward, and this is the, now coming to the step number 5, calculation of CGT. CGT liability will be students the taxable gain into appropriate percentage. The, let's mention here the percentage, then less payment on account of residential property disposal, that is, this will be a separate calculation X. This will be the CGT payable. Now students, we will be covering step number 3 to step number 5 in more detail. I hope this format is clear to all of you. This format we need to follow students. I hope this format is clear. The step 1, the chargeable gains less allowable loss. We will be using the step number 1, the format, disposal proceeds less incidental cost less allowable expenditure. We will arrive to the chargeable gains allowable loss. Then we need to net it. The step number 3 is less AEA. Before that, any trade loss set of relief. This we have covered in the chapter number, that is the chapter number 10 or 11 under the income law. This we have covered students in the chapter number, the losses for individuals, the loss relief for individuals. This we have covered under the chapter number 10 students. This we have covered under the chapter number 10. Then any less capital loss brought forward, taxable gains. Then we need to calculate the CGT liability. CGT liability will be calculated on taxable gains into percentage less payment on account of residential property disposal will give rise to the CGT payable. Now students, we will be covering the step 3 and step 4 in more detail. Annual exempt amount. Every individual is entitled to an annual exempt amount for each tax year. For 23-24, the annual exempt amount is £6,000. The A is deducted from net chargeable gains for the tax year, that is after current year capital loss but before capital loss brought forward. So the EA is deducted before current year capital, is deducted after current year capital loss but before capital loss brought forward. If an individual net chargeable gains after current year disposal for the tax year are 6,000 or less, the individual is not chargeable to tax. Means if the net chargeable gains is 6,000 or less than 6,000, there will be no CGT tax. In excess of 6,000, the individual is chargeable to tax on excess unless these are covered by capital loss brought forward. If the AE is not utilized in a particular year, then it is wasted. It cannot be carried forward backward to another tax year. So the AEA is of 6,000 pounds and it will not be carried forward or carried back. And if the net chargeable gain is more than 6,000, then the tax will be applicable. If we have capital loss brought forward, it will further reduce the amount. For the purpose of examination, chargeable gains means the gains before deducting the annual exempt amount and any brought forward capital loss. Taxable gain means the gains after deducting the annual exempt amount and any brought forward capital loss. So students, the chargeable gains in the examination it is mentioned chargeable gains means gains before deducting the annual exempt amount and any brought forward loss. Chargeable gains means if anything is mentioned like chargeable gains, this is before the deduction of AEA or trade loss, set off relief or brought forward loss. If it is mentioned as taxable gains, it means after deducting the annual exempt amount and any brought forward loss. The format is clear. In the net chargeable gains, if it is not mentioned net, it will be mentioned as chargeable gains. I hope this is clear, students. As we have seen, net chargeable, this is allowable loss or current year capital loss students. I hope this is it. The AEA is clear. The AEA is an exempt amount which the CGD will not be taxed. After net chargeable gains, we need to reduce the AEA. Before that, if we have claimed any trade loss set off relief, we need to set off that, then we need to use the AEA. If in the examination it is mentioned chargeable gain means before the deduction of annual exempt amount and any brought forward loss, capital loss. But taxable gain means after deducting the annual exempt amount and any brought forward loss. I hope this is clear, students. I hope this is clear. The step number 3 was deduction of AEA, that is 6,000 pound. So students, here in our case students, as we have seen, chargeable gains means students before deducting AEA and brought forward loss. But taxable gains means students after deducting AEA and brought forward loss. I hope this point is clear, students. I hope this point is clear. Then coming to the capital losses, students. Then moving to capital losses. We have two types of capital losses for CGD: current year capital loss and brought forward capital loss. Current year capital loss arising on assets in the current tax year are set off against chargeable gains arising in the same tax year to the maximum possible extent. That is, they cannot be restricted to avoid wasting all or part of the AEA. So this means, students, current year capital gains we need to set off against the tax year, these chargeable gains in the same tax year against the chargeable gains. So in that case, to the maximum possible extent, and so they cannot be restricted to avoid wasting all or part of the AE. So partial claim will not be allowed, students. Simple. This means that we can't elect the amount which we can set off against the current year. As we have seen, chargeable gains less allowable loss. Allowable loss means current year capital loss. and this current year capital loss we need to set off. There must be maximum set off. There must be maximum set off. No partial claim is allowed. Any unrelieved unused capital loss are carry forward to offset against chargeable gains in future years. If we are not able to set off the whole chargeable loss, the allowable loss, then we need to carry forward it into the future years. Then brought forward capital loss. Brought forward capital loss are offset against the first available net chargeable gains after the AEA. So the brought forward capital loss are set off against the first available net chargeable gains after the AEA. After the AEA we deduct the brought forward loss. Any remaining brought forward loss are carry forward for future offset against future chargeable gains. As we have seen, students, the case of property losses, trading losses, we will also have the capital losses, and the capital losses arising on the assets in the current year will be set off against the chargeable gain immediately before the AEA. Before the AEA we need to set off the current year capital loss, and there is no partial claim allowed. We need to set of it maximum possible extent. They cannot be restricted to avoid wasting all or part of the AEA. So we can't restrict the amount. So if further loss is there after relieving against the current chargeable gains of the current tax year, further loss is there, then the unrelieved loss, capital loss are carry forward to offset against the chargeable gains in future. Then brought forward capital losses. So brought forward capital losses will be deducted after the AEA, and if further loss is there, we will carry forward, students. If the total, we will reduce the brought forward capital loss and it will give rise to the figure of taxable gain. If it is negative, then further we'll carry this loss. If it is positive, we will charge CGT. I hope the capital loss part is clear, students. The capital loss part is clear, students. Capital loss part is clear. Now coming to the step number 4, capital loss brought forward, we will deduct it, no issues. Then we have seen the format also, students. We have already covered the format, no issues in that. Now students, we will be dealing with the capital losses. We will be dealing with the capital losses, students. We will be dealing with the capital losses. I hope this is clear, students. Now coming to the case of capital losses. So main basic points here, students, is we have current year capital loss, current year capital losses, and brought forward capital losses. Same, students, we have seen in the case of losses for individuals also. In the companies we have seen the capital loss will be set off against the current year chargeable gains and then future years. So current year capital gains, students. So the current year capital gains, that is capital losses arising on asset in the current year. In the current year are set off against, students, are set off against chargeable gains. We have seen the format, students. The step number 2 is chargeable gains less allowable loss. The allowable loss is known as the current year capital loss, students. Here we have seen in the format, that is allowable loss, students. Please do remember this, allowable loss. So against chargeable gains arising in same tax year, students, arising in same tax year. So the capital loss arising in the arising on assets in the current tax year set off against chargeable gains arising in the same tax year. I hope this is clear, students. Then the second most important point is that the chargeable gains will be set off to maximum possible extent. Maximum possible extent, that means no partial claim is allowed. We can't, partial claim means, students, we can't restrict the amount, we can't select the amount which we need to reduce. We need to reduce it to the maximum possible extent. No partial claim allowed. I hope this is clear. The current year capital loss is clear. So students, if we have any unrelieved loss, then it will be students, it will be carried forward. It will be carried forward, students. It will be carried forward. This is the second. Any remaining loss, remaining or unrelieved loss, any remaining or unrelieved capital loss will be carried forward to set off against future chargeable gains. Future chargeable gains. I hope this is clear, students. Now coming to the brought forward rules, students. Brought forward loss. As we have seen, students, brought forward loss means brought forward losses will be set off, students, after the AEA. Please do remember, brought forward losses are offset against the first available net chargeable gain, student. It is not the chargeable gain, it is the net chargeable gains. If you carry forward it to the next year, then current year gains, current year loss, then you will come to the trade loss set off AEA, then brought forward loss you will set off. First available net chargeable gains after the AEA. Any I hope this is clear, student. And any remaining loss, if further remaining loss is there, any remaining brought forward loss losses are carried forward, students, are carried forward for future offset against chargeable gains, students, against future chargeable gains. I hope this point is clear, students. As students, we have already seen the capital losses for companies. The capital losses for company will be set off against the current year gains and then future year capital gains. But partial claim for the current year was not allowed. For both, in the case of company, students, in the case of companies, the carry forward we can do for indefinite period of time. The carry forward can be done for an indefinite period of time, students. But students, but the partial claim was not allowed. The partial claim was not allowed. The partial claim was not allowed for companies. But coming to the case of individuals, in case of companies, no partial claim was allowed either in current year or future year. But coming to the case of individuals, current year capital loss, no partial claim is allowed. But brought forward loss, partial claim is allowed. Partial claim is allowed. For partial claim is allowed for brought forward losses. I hope this is clear. But in case of company, students, no partial claim was allowed. But in case of individuals, partial loss will be allowed for brought forward loss. I hope this is clear. Now we will be seeing a question of losses. No, students. Tom and Jerry made chargeable gains and allowable loss for the tax year 2022-23 and 2022-23 and 23-24 are set out below. 2022-23 chargeable gains, allowable loss. 2023-24 chargeable gains and allowable loss. Calculate the taxable gains for Tommy and Jerry for tax year 2023-20, 22-23, 23-24 and the amount of any loss carried forward. So students, for both of them we need to do. So as they have given chargeable gain students, first we need to calculate the net chargeable gains. So net chargeable gains will be chargeable gain less current year capital loss for Tom 22-23. So students, the first one is the format which the chargeable gain, students, the chargeable gains is 12,000. I hope this is clear, students. Chargeable gains. Then less allowable loss, students. Please do remember the format. The step number 1 was the calculation of the chargeable gain or chargeable loss. They have given, the step 1 has been done. Now we need to calculate the step number 2. That is net chargeable gain, and net chargeable gain will be, students, chargeable gains less allowable loss. So the less here, students, we have done this format. Please do remember here. This format we have already done, students. See, this format we need to work. Chargeable gains less current year capital loss, that is allowable loss. We will be doing this. So less allowable loss, students, less allowable loss, that is allowable loss or current year capital loss, current year capital loss, students. So current year capital loss will be 8,000. So this will give rise to the net chargeable gain. This will be 4,000. Net chargeable gains. I hope this is it. So same we will be doing for Jerry for 22-23. As it is mentioned, students, the chargeable gains for Jerry was 4,000 pound and the less capital, the loss was 7,000, students, and we need to set off the full amount. We need to set off the full amount. So students, we need to set off the full amount. So here we will only set off 4,000. So here it will be the chargeable gains for it will be Jerry 2,000. So now students, coming to Tom for 23-24 and Jerry 23-24. Then students, the next was the any trade loss set of relief. Nothing is mentioned. Then AEA. So EA 6,000. It will be, we can claim only 4,000. So the taxable gains will be students 0 here, and here also it will be 0. So now students, for case of Tommy to 2023, it is already mentioned that the chargeable gains is 14,900, 2,000, 8,000 and 1. So students, here in case of Jerry, the brought forward loss will be brought forward loss of 3,000. Brought forward loss of 3,000 students. So now chargeable gains students, same. The chargeable gains, the every year we need to follow this format, chargeable gains. The first one, in case of Tommy it was 14,900 less capital loss of current year. Current year they have allowable loss students. First we need to set off the current year. No brought forward loss, nothing. Here also no brought forward loss. We have done that. The 2000 for the Finance Act of 22 we have done. Now Finance Act 23. So less allowable loss current year. So it was 2000. So this will be students. This will be students 12,900 less trade loss set off relief, no, less AEA, yes we can claim AEF 6,000. Any brought forward loss, no brought forward. Previous year also we did not have any brought forward loss, but here also we don't have, so it will be our taxable gains. So our taxable gains will be students 6,900 for the tax year of 23-24 and tax year of 22-23 0. Now for Jerry, the chargeable gains is students 8,000, allowable loss is 1,000. So the net chargeable gains, is students 7,000. Then current year we have set off less AEA students, less AEA, less AEA students, less AEA, less AEA students. Now, but we have a brought forward loss of 3,000 students. We have a brought forward of loss of 3,000 and the brought forward loss will be set off after the AEA. So we'll claim the AEA full. So in the brought forward year students, the partial claim is allowed. If we deduct 3,000, then we can only claim 4,000 of annual allowance, the AEA, the annual exempt amount. But students, when the loss is brought forward, we can do partial claim is allowed. So we will claim the full annual exempt amount, because the annual exempt amount cannot be carried forward students. The annual exempt amount will not be carried forward, but the loss can be carried forward to indefinite period of time. So here we'll claim 6,000 less 1,000 students, less brought forward loss, that is the less brought forward loss, less brought forward loss, here it was 0, in this case it is 1,000 students. So the taxable gains will be 6,000, it will be 0. So the remaining brought forward loss will be students still 2,000. I hope this is clear. As we have already mentioned, partial claim is allowed for brought forward loss. So we can restrict the amount so that the AEA will not be wasted. So that the AEA will not be wasted. And students, we have seen we need to claim full AEA in brought forward loss, because AEA cannot be carried back or carried forward, but brought forward loss can be carried forward, but brought forward loss can be carried forward. I hope this is clear, students. I hope this point is clear, students. And students, important point is that brought forward losses can be carried forward for indefinite period. It can be carried for indefinite period. It can be carried forward, students. It can be carried forward for indefinite period. I hope this is clear. We have already seen, we have now completed the losses. Now students, we will be seeing the calculation of CGT now, the last important topic. As we have seen, the step number 1 done. Step number 2, net chargeable gains, that is the chargeable gains less current year loss. We will arrive to our net chargeable gains. Then any loss, trade loss, set of relief has been claimed, less AEA, less brought forward loss. We have done this. And for brought forward loss, partial claim is allowed. Then we will arrive to our taxable gain. The step number 5 is calculate the CGT payable for tax year. Now we need to see the CGT calculation. Now we will be seeing the CGT calculation, students. We have a lot of topics to cover, students. Computation of CGT payable. CGT is payable on the taxable gains arising in a tax year. As we know, CGT is paid on the taxable gain arising in the tax year, student. CGT is payable on the taxable gains arising in the tax year. CGT is payable on the taxable gains arising in the year as follows. The rate of CGT is dependent upon the amount of taxpayers' total taxable income. So students, the rate of CGT is dependent upon the amount of taxpayer total taxable income. As this we have seen, students, in our income tax calculation format. The last one was the taxable profit. Our total taxable profits for non-saving, saving and dividend will give rise to the total taxable profit. So we need to see this figure so that we can identify our rate of CGT. The rate of capital gain tax is dependent upon the amount of taxpayers' total taxable income after deduction of personal allowance and the type of asset disposed of. So students, the rate of CGT will depend upon the taxpayer total income and the type of asset disposed. Taxable gains are taxed after taxable income. So this means, students, taxable total income. The taxable gains are taxed after taxable income. So the taxable gains are taxed after the total taxable income. That is as the top slice of income. After the total taxable income, the taxable gains will be taxed. But do not combine income tax and the gains in one computation. So students, the rates are different. The rates will be different, but we will only be using the total taxable income and the bands to identify the rate of CGT. But the computation will be totally different. Both of the income tax is a different act and CGT is a different act. I hope this is clear. Generally where taxable gains falls into the basic rate band, CGT is at 10%. That is, let's take an example, students. Our taxable total profit is 30,000. So till here it will be taxed at basic rate. We will follow the income tax calculation, the non-saving, saving and dividend rates, etc. Then we have a CGT, the capital gains. CGT will be applicable on the, is payable on the taxable gains arising in the tax year, and the rate of CGT will depend on the taxpayer total taxable income, and the CGT rate will be decided, and the taxable gains will be taxed at the top slice of income, and where the taxable gains fall in the basic rate tax band. So the basic rate band is 37,700. So 7,700 will be taxed, the gain will be taxed at 10%, and further it will be taxed at 20%. So for determining the rate of CGT, two important things. We need to see the taxpayer total taxable income and the type of asset disposed. Then where the taxable gains falls in the basic rate band, it is 10%. Generally, to the extent that any gains or any part of gains exceed the basic rate band, they are taxed at 20%. So in CGT we have two types of rates, student, 10% and 20%. 10%, 10% and 20%, and we have further rates for residential property we'll be covering now. So first we need to see the taxable total income, and then after that the CGT, the CGT rate will be decided for the taxable gains. And if it is the basic rate, 10%, above basic rate 20%. Higher rates of CGT apply to certain residential property. If the basic rate band is extended due to gifted donation or personal pension contribution, then extend basic rate band is also used to establish the rate of CGT. If the band is extended, we will follow the extended band rules. Any unused income tax personal allowance cannot be used to reduce the taxable gains. So students, please do not confuse. The personal allowance is for the income tax calculation, and AEA and personal allowance will not interchange. AEA is for capital gain tax and PA is for personal income tax calculation. But to identify the rate of CGT, students, we will be using we need to see the total taxable income and the bands and the type of asset disposed. If in examination question requires calculation of income tax and CGT, two separate calculation must be prepared, one for income tax and one for CGT. One for income tax and one for CGT, student. So the capital gain tax is payable on the taxable gains. Now to determine the rate of CGT, students, we need to see two things: taxable total income of the taxpayer and the asset disposed of. Then the taxable gains will be treated as the top slice of the income. So taxable total income, then the taxable gain comes, but we'll be using the bands to determine the rate of tax. If it is within the, if the taxable gain is within the basic rate at 10%, above basic rate 20% for all the assets. But residential property we have different rates, we'll be seeing it. And the annual allowance and the AEA, the personal allowance and the AEA will not be confused. Personal allowance is for the income tax and AEA is for the capital gain tax. And if any examination question requires calculation of income tax and CGT, two separate computation needs to be prepared, students. Two separate computation needs to be prepared. Two separate students needs to be prepared. I hope this is clear. So now students, we will be looking to the rates. Rates of CGT. Rates of CGT. CGT is paid at normal rates unless the gain arises on the disposal of residential property. So for all the asset, students, for all the asset the rate is 10% and 20, but for residential property it is 18 and 28%. I hope this is clear. So students, gain falling in basic rate band will be charged at 10%, and residential property it will be charged at 18%. Gain in excess of basic rate band at 20% and 28%. I hope this is clear, students. I hope this is clear. The rates of CGT will be determined by using the total taxable income, and above that we need to see the taxable gains will be treated as the top slice of the income, and we need to see the taxable gains fall in the basic rate limit. For the basic rate limit it will be taxed at 10% for normal rates and 20% above basic rate band, and for residential property it is 18 and 28%. In practice, a taxpayer main residential property, the taxpayer homes will be exempt from CGT under the private residence relief. Will be covering this. However, where the gains on the disposal of residential property is not fully exempt, example, an investment property which is let out is taxed at higher rates. Is taxed at higher rate, students. So residential property, if I am using the property for my own use, then we have a relief known as private residential relief. Will be covering in detail there. But the residential property will apply. The residential property rates are 18% and 28%. I hope this is clear, students. The private residential property which I am living, if an individual is living in his home, if he sells that, then he will have a relief known as private residential relief. Certain amount will be exempt and certain amount will be taxed. We'll be seeing that. But till now, you need to assume that the residential property will apply on residential property which are let out. I hope this is clear. Residential property will include the main residence also, student, but it will be exempt from the CGT under the private residence relief. And under the private residence relief, we will study the amount of relief which is available. The amount eligible for relief, exempt. Further amount which is not eligible for the PRP relief, this is known as PRR relief, PRR, private residence relief, we will tax at 18 and 28%. But till now, you need to understand that residential property means investment property which is held out. Then, moving to the offset of AEN capital gain tax. Before that, students, first we will be making some notes. Now coming to the computation of CGT, capital gain tax. CGT is paid on taxable gain. This I hope is clear. Now students, coming to the rates of CGT. To determine the rates of CGT, students, to determine the rate of CGT, we need to consider two things. First one is total taxable income. Total taxable income, and the second one is the asset disposed of. Asset disposed of. So students, as we have seen that the taxable gain will be treated as the top slice of the income after the total taxable income, and if the taxable gains fall in the basic rate limit, we'll apply the rate. If higher rate limit, if falls above basic rate limit, then we will apply the rate. Here no additional rate band, only basic and higher rate band, students. So the rates of to determine the rate of CGT, we need to consider two things: total taxable income, assets disposed of. Type of asset disposed of. Type of asset disposed of, student. Type of asset disposed of. So the taxable gain will be treated as top slice of income. Top slice of income. That means, students, our taxable total income will be till here, then the taxable gains will come here. I hope this is clear. To identify, the first step is we need to see the taxable total income. After the taxable total income, the taxable gains will come. But students, important point here is to note that CGT computation and income tax computation are both different. Only to determine the CGT rate we are using this. Only to determine the CGT rate we are using it. Now the taxable gain, students, please do see here. Taxable gain, if taxable gain, after this, now we need to see whether taxable gain falls in basic rate band, or now we need to, after this, we need to see whether taxable gains falls in basic rate band or above basic rate band. Excuse me. It will be same as the band, students. So first we need to see whether taxable gains falls in basic rate band or above basic rate band. If taxable gains falls in basic rate band after the taxable total income, students, please do keep in mind, taxable total income. If the taxable gains falls in the basic rate band after the taxable total income, students, then we need to see the type of asset disposed. We need to see the type of asset disposed. Type of asset disposed. Type of asset disposed. If normal asset, normal rates and residential properties. If the type of the asset disposed is normal, the rates will be, students, 10% and for residential it will be 18%. I hope this is clear. Within the basic rate band. Now students, if taxable gains are above basic rate band, then the CGT rates, then the capital gain tax rate for type of no students, 1 minute. If taxable gains are above basic rate band, then the capital gain tax for the type of asset disposed will be students, will be above basic rate band. Normal rates and residential property rates, that is, here it will be 20% and this will be 28%. I hope this is clear, students. An important note is that income tax and capital gain tax both are different computation and should not be combined. I hope this is clear, students. So the capital gain tax, students, the rates of the CGT will be decided based upon the taxpayer total income. First we'll see the total taxable income, then the rest space will be using for the CGT rates to be determined, and the type of the asset disposed of. If students, the gains is falling after the total taxable income, the capital gains tax will, the taxable gains will come into picture. The taxable gains if fall in the basic rate band, then for normal assets it will be 10%, if above basic rate at 20%, and for residential property it will be 18% and 28%. I hope this is clear. The selection of the rates of tax is clear. The selection of the rate of tax is clear. The selection of the rate of tax is clear, students. The selection of the rate of tax is clear. Now students, we will be coming to the, as we know that the residential property has 18% and 28% now, and the normal rate is 10 and 20. Now we will see, students, how we will offset the AE and capital losses. We will see how we will set off the order for setting of the capital losses and AEM. Taxpayer can offset the AE and capital losses against whichever gains they choose. We can choose whichever gains we want, whether residential property gain or other gains. In order to maximize the relief, they should be offset firstly against residential property gains, as they are taxable at higher rates than other gain. The unused basic rate may also be used in the most beneficial way. The tax saving is the same regardless of the gains against which it is used, as switching gains taxed at 18 to 28 to 18% or switching gains taxed to 28 to 10%. In your materials, the unused basic rate band is firstly offset against other gains. So students, this is very complex, no need to deal with this. This is only an example, general understanding you need to have. I'll be giving an example. So students, the order, now we have seen the CGT rates are two rates, normal rate and residential property. Now when we prepare our format, the format of chargeable gains, less allowable cost, less the AEA, less brought forward loss, etc. Then we need to see, students, we will be having residential property gain also and other gains. So now we are seeing the order of offsetting the AE and capital losses. The basic rule here is, students, to set off the order to set off AE and capital losses is first against the residential property gain and then other gain. Because as we have seen, the residential property gain is taxed at higher rate, that is 18 and 28%. So first we will set off the AEA and capital loss against this, then come into other gains. But what does this paragraph say, students? This says that if you set off against other gains and capital gains, the 10%, that is 28 to 10 is 10%, and this is 20 to 10%. The relief will be the same only, but the extra relief will be the 8%, students. I hope this is clear. Let's take an example. The unused basic rate may also be used in the most beneficial way. The tax saving is the same regardless of the gains against which it is used, as switching gains taxed at 28% to 18% or switching gains taxed at 20% to 10%. Procedures the same results. Proceeds the same result. Because students, here the percentage of saving is 10%. If below basic rate, it will be taxed at 18%. Above 28%. So the saving will be, if this students, if the residential property has been first offset against the A in capital, so the relief will be at 10% only. I hope this is clear. And if it is 10 to 20%, the saving will be 10%. This you need to have an understanding. No need, students. The basic here point is, we will be writing that the order to offset AEA and capital losses, students. Capital losses. The first one will be the residential property gain, and the second one will be other gains. And the third one is, students, we will be mentioning here, but further in our next to next chapter we'll be covering this BADR gain and investor relief gain, BADR relief gain or investor relief gains. This will be covering in our next chapter, no issues. You need to keep in mind the order to offset AE and capital losses. The first one is residential property, then other gains, then BADR. This will be covering, no issues. First you need to keep this two in mind, students. This two is important. So the AE and capital losses will be set off against residential property gains and other gains. Now students, many of the students will be having a doubt, what will be the format for calculating the tax, the order of calculating the tax. The order for calculating the tax. So students, the order for calculating the tax, now we'll be seeing order for calculating CGT. So students, here also the first one will be the first we need to calculate the income tax. So first we need to calculate the income tax, students. I hope this point is clear. First we need to calculate the income tax, students. Then the order for calculating tax. First we need to calculate the income tax. Then second, after the income tax is calculated on the total taxable income, students. Total taxable income. Then the second one we will calculate the for BADR and investor gains. This you only need to keep in mind, students. We'll be further covering it at 10%. This will be studying further. Then the third tax will be on residential property gain. Then the fourth one will be, students, the fourth one will be other gains. Student, this is also a gain. This is also CGT gain only, but it will be restricted to 10% and we will be studying what are the conditions. But now you need to keep in mind the order of offsetting the AEA is residential property, other gains, then BADR gains and investor relief gains. But the order for calculating the tax, first we need to calculate the income tax based on the total taxable income. Then we will calculate the total taxable income. After that the CGT picture will come into, the CGT capital gain tax will come into picture, students. But capital gain tax will come into picture, but before that we have BADR and investor gains that will be restricted at 10%. That will consume your basic rate band. This will consume your basic rate band. This we will be covering in more detail in our next class. No issue, students. But now after calculating this, you need to calculate the tax for residential property gain and other gains. I hope this is clear, students. I hope this is clear. The order of offsetting, we are offsetting the residential property AEA first because it is taxed at higher rate. I hope this is clear. Then other gains. But when calculating the tax also, first we need to calculate the income tax, then residential property, and then other gains. I hope this is it. This we will be covering, students. But you need to remember this format so that when we do this topic, you will not confuse. Let's take an example, students. So much we have done theory, now we'll be taking an example. Let's take an example. A residential property has been sold and results in a gain of 10,000 pounds. And a painting has been sold and results in a gain of 5,000 pounds. Calculate the CGT, capital gain tax. Now students, as we know the format, here they have already given the first part, the step number 1 has been done here. They have directly given the chargeable gains. So students, and let's take our brought forward loss is of 2000 pounds, brought forward loss. So now students, the format, I hope you remember the format. The first format was the chargeable gains less capital loss of current year, then we will arrive to our net chargeable gain, students. Then we arrive to our less trade loss set of relief claim, trade loss set of relief, then less AEA, less brought forward loss, then students taxable gains. I hope this point is clear, students. This point is clear. Then let's take the taxable total income. The taxable total income will be, students, 30,000 pound of an individual. This is the question we have. This is the question we have. This is the question we have, students. So we will not do the residential property, because for residential property we have further rules. First we'll be doing for some other case, students. Let's take it is a VAS. So the chargeable gains is, students, the chargeable gains is 10,000 plus 5,000. It is 15,000. Less any capital loss, students? No capital loss. So 0. Then our net chargeable gains will be 15,000. Any trade loss set of relief, students? No, 0. Then AEA full will claim, because partial claim is allowed. So the loss, brought forward losses, students, so the brought forward losses 2,000, students. This will give rise to our taxable gains. 15,000 minus 6,000, it will be 9,000 plus 7,000. I hope this is clear, students. Now students, we need to calculate the CGT, capital gains tax. Capital gain tax. Now students, to calculate the capital gain tax will be calculated on the taxable gain. Taxable gain is 7,000. Now we need to determine the capital gain tax rate, and this we need to see two things. Total taxable income. Our total taxable income is, students, 30,000 pounds. Total taxable income. So this is 30,000. Then asset disposed of. As there is no residential property disposal, we have changed here, students. Please do keep in mind, because residential property have some different rule will be seen. This you need to think, as we are using the calculation for normal rates. The residential will be seen afterwards. The asset type. As we have seen, there is no residential property, so the asset type is normal. So now students, the capital gain tax, this is our total taxable income. The capital gain tax will be treated as the top slice of income. Yeah. Now the rate of tax will depend on the tax band. Our tax band is 37,700, students, and 125, 140. Only basic rate is enough. So students, our band is 37,700. As this capital gain tax, the taxable gain is falling under the basic rate band. So basic rate band, we have the percentage of 10%, students, 10%, and the rates you need to learn, students. The rates will not be provided in the examination. The rates for normal rates and residential property range needs to be learned. 10% and this you need to learn. I hope this is clear. 10% and that if above this 20% normal. So our capital gain tax will be, student, as this is within the band, so into 10% it will be 700. I hope this is clear. I hope this point is clear, students. Now taking another example, let's take the same example, students. Let's take a taxable gain is 10,000 pounds and we need to calculate the corporation CGT is payable on the taxable gains, and the same example, our total taxable income is 30,000 pounds, students, and our taxable gains will be treated as the top slice of income. But students, here our taxable this is, students, basic rate is there. Within the basic rate limit, the taxable gain of this much is falling, and above basic rate banded is, students, 3,000, 2,300. This is within the basic rate limit and this is above and within. So the rate of CGT will be, students, 7,700 into 10% and 2,300 into 20%. I hope the calculation of CGT is clear. How we will calculate? We need to see the tax band, students. Taxable income. After the taxable income, the taxable gain will be treated as the top slice of income, and then we need to see the taxable gain in which basic falling in which limit. If it is above the basic rate limit, direct 20%. Within basic rate limit, the band 10% and above basic rate limit 20%. I hope this is clear, students. And if we have any AEA or brought forward losses, first will be set off against the residential property gain, then other gain, and we calculate the tax also first for the residential property, then for the other gains. Now students, coming to UK residential property disposal. UK residential property disposal. Now coming to the case of UK residential property disposal, students. Disposal of, as we have seen, students, the rate of tax differs on the normal assets and residential property. If normal asset within the basic rate band 10%, above basic rate band 20%, and residential property within basic rate band 18%, above 28%. Now we will be seeing the UK residential property disposal. Disposal of UK residential property must be reported to HMRC within 60 days of completion, along with a payment on account of the relevant CGT liability. Students, already we have seen this, that in the format we have seen the CGT liability less payment on account already paid for residential property. When we compute, students, when we compute the CGT, we need to compute for residential property other gain also. But HMRC says that whenever a residential property is sold, that is other than the individual's main residence. If it is main residence also, it will be included, but we have a relief, we will be covering further. But simple point is that if it is a UK residential property, then it must be taxed and the tax amount must be paid within 60 days of the completion. If the residential property is sold on 1st Jan, it must be paid, the CGT liability must be paid within 60 days. It must be paid within 60 days. So disposal of UK residential property must be reported to HMRC within 60 days of completion, along with a payment on account of the relevant CGT. So payment of the CGT must be done. The rate of CGT is determined using an estimate of individual's income at the time of the disposal to estimate how much basic rate band will be remaining. In question involving the calculation of tax due, an indication of whether the taxpayer is basic or higher rate, or an estimate of the income will be provided. So students, if we need to pay the CGT liability for the residential property, within 60 days. We need to pay within 60 days. So we need to pay within 60 days. How we will calculate the CGT liability? The CGT liability will be calculated basis on the estimate of the income tax liability, because the CGT is calculated after the total taxable income. So we will not be knowing the total taxable income, so we'll take an estimation. Losses brought forward: current year capital loss realized prior to the residential property disposal and the AA may be offset against the gain when calculating the tax due. Any loss incurred subsequently are ignored. So what does this point say, students, is that brought forward losses, current year capital losses realized prior to the residential property disposal and the AEA may be offset against the gain. So students, when we dispose of the property in between, let's take an example. 1st Jan we dispose of the residential property, then till 1st Jan what all are the brought forward loss, what all are the capital loss, you can offset it. I hope this is clear. But students, when coming to the final computation, we'll be doing the final computation. In that, no issues. Residential and other. But as we know that whenever the gain is there on the residential property, we need to pay within 60 days. And the computation will be that the chargeable gains will be having till the date of disposal, whatever losses you have incurred, whatever the brought for, whatever the A, you can set off it off. You can set it off and you can calculate your residential property gain and the tax CGT amount, and within 60 days it needs to be paid to the HMRC. There is no need to submit a return if there is no CGT due. For example, if the gain is covered by AEA, private residential relief, or the asset is sold at loss. If there is no tax, if the net figure is not gain, then no need to tax it, student. Then no need for the submission of the return. I hope this is clear. If we are selling a residential property, we need to submit a return to the HMRC within 60 days and pay the liability also within the CGT liability within the 60 days for the residential property gain. But if there is no CGT payable, then no need to submit the return. So it will be if the gain is covered by AEA or private residence relief or the asset is sold at loss. All disposal made during a tax year, including any residential property disposal, are included in the final tax return. That is, when we prepare the final tax return, are included. Any payment on account made is deducted from the CGT liability to reach the final amount of CGT payable. The amount paid may be provided or you may be required to calculate it. So students, the format which we have seen earlier was the format for the annual calculation. And if any CGT liability is paid on the residential property based on the estimation figures, it will be reduced. But when we calculate our annual calculation, we need to perform whole calculation. Either in the examination it will be provided, either that the CGT has been paid on residential property or you need to calculate. If a repayment is due, it will be claimed on the CGT return. If any repayment is there, it will be claimed on the CGT return. Calculation of payments on accounts on multiple residential property disposals are not examinable. So multiple residential property disposal will not be examined. Either one disposal they'll give you in the tax year. Only one disposal will be given, students. I hope this is clear. Then moving to the payment of CGT. CGT is due as follow on 31st Jan following the tax year, that is 31st January 2021. So students, we have seen that for residential property, we need to pay and submit a return within 60 days. But coming to other CGT payable, the annual CGT liability payable, the date of paying it, as we have seen in our format, students, please do remember, for UK residential property, we will pay it, students. We will pay it within 60 days and filing a return. We need to file a return. But when we perform an annual calculation, we need to deduct that. We need to deduct the payment which has been made. But this we are paying in 60 days. But when compared to the other CGT when it needs to be paid is that 31st Jan following the tax year, that is for 23-24 it is 31st Jan 2025. You need to pay the CGT amount. Payments on account for UK residential property are deducted from the final liability. Taxable gain, calculate the CGT liability less payment on account, you will get the payable final CGT liability. So this final CGT liability will be paid on 31st Jan 2025. I hope this is clear, students. I hope this point is clear. Now we will be seeing the UK residential property, students. So UK residential property disposal. So if there is a disposal of UK property, students, we need to submit a return and pay CGT, the capital gain tax on residential property. We need to submit a return and pay the CGT on residential property to HMRC within 60 days of the disposal of the residential property. I hope this point is clear, students. Now coming the format. See, students, the first format which we have learned is the total format, and we need to perform each year end. The annual calculation needs to be performed. But when calculating the residential property, it will be the chargeable gains of the residential property chargeable gains less loss, current less allowable loss till the period, less allowable loss till the period you sell the residential property. Whatever loss you have, you need to consider it. Then less students, it will be the capital allowable loss up to the date of disposal of residential property. Then less trade loss set off relief, not trade loss set off, students. Here you need to consider the AEA. That was the final format. This is the AEA. As we have seen, students, it is mentioned here. Brought forward losses, current year capital losses realized, means before selling this residential property, we have brought forward loss and capital loss prior to residential property disposal, and the AEA may be offset against the gain when calculating the tax due. Whenever we are calculating the tax on the residential property gain, we need to offset these three items, and any loss incurred subsequently are ignored. That is AEA less brought forward loss will give rise to the taxable gains. I hope this is clear, students. Note the annual CGT computation needs to be made including residential property gain. The annual CGT computation needs to be made including residential property gain, but the payment on account needs to be deducted from CGT liability. I hope this is clear, student. This, whenever we dispose of a residential property within 60 days, we need to submit a return by paying the CGT liability, and we will follow this format, student. And before the disposing of the CGT, disposing of the chargeable the residential property, before disposal of the residential property, if we have any loss, we can set it off, and the brought forward AEA loss we can set it off the current year capital, and then we can pay the CGT. But in the annual calculation we need to include all the things, students. I hope this is clear. And the CGT due date for other gains is 31st Jan 2025. You need to pay this. The CGT for other gains needs to be paid by 31st Jan 2020. The CGT due date for other gains is 31st Jan 2020. Means we need to pay within or by 31st Jan 2025. I hope this is clear, students. See here, students, please do remember the format here. Less payment on account of residential property disposal. Whenever we calculate if we have residential property disposal, we need to pay the CGT liability within 60 days. So we'll calculate based on the estimation and we'll pay the amount. But when we perform the final calculation, we need to include the residential property and we need to perform the whole calculation again and then less the payment which we have paid. I hope this is clear, students. Now we will be doing a question so that we have a better understanding, students. Calculation of CGT payable. In the tax year 2023-24, J realized the following chargeable gains. Residential property 34,300. Okay, the gain amount they have given. Antique table 20,000. J has taxable income of 28,700. In the tax year 22-23, J has income tax of 28,002 for the tax year 23-24, students. It is J estimated the CGT due and made a payment on account of 7,860 pound. Calculate J capital gain tax payable for the tax year 23-24, students. So now, as we have seen, students, the format, and directly we have a residential property, we need to pay the payment within 60 days, but they have already done the calculation and they have given the payment on account, no issue. Now we will do the annual calculation. Calculate J's capital tax payable for the tax year 23-24. So students, so we have seen we have two types of gain. So the first we will write the residential property gains and other gains. I hope this point is clear, students. Then coming to the chargeable gains. Chargeable gains include the residential property, gains, chargeable gains. It is, students, 34,300. See, students, the format we are following the same only, the chargeable gains. The chargeable gains. Please do remember, students, the format is totally different, students. The format which we have learned will be following same only. But as we know that we have two rates of CGT, so will divide or we mention the residential property and other gains separately, because do remember students, the AEA will be set off against first the residential property then other gains, and the tax will also be calculated first for the residential property and then the other gains. Students, please do see here, we have mentioned here other residential gain, other gains, AEA set off, order for calculating income tax, then residential and then other gains. This, let's take an example. Yeah, now coming to chargeable gains. So chargeable gains, students, for residential property it is 34,300, then antique, table it is 20. Less students, any loss, current year loss, nothing is mentioned. So this will be our net chargeable gains, 34,300, 20,000. Then less students, trade loss set off relief, nothing is trade loss set off relief, nothing is provided. Less AEA. Now AEA, students, we need to set off first against the residential property, so 6,000 whole we can reduce it. Then less brought forward loss. Any brought forward loss is mentioned in the question, students? Nothing is mentioned, so it is 0, 0. So this will be our taxable gains. So our taxable gains will be, students, 28,300. Let's make a total column also, students. $54,300 less AEA, this will give rise to 48,300 and this is 20,000. Now students, this we have done till step number 4. Step number 4 is done. Now coming to step number 5. That is CGT calculation, capital gain tax. Capital gain tax is calculated on the taxable gain, students. It is calculated on the taxable gains. The taxable gain is, students, 48,300. Now this includes residential property gains and other gains. Residential property is 28,300 and the other gains is, students, 20,000. I hope this point is clear. 20,000. Now the corporation, this capital gain tax, we need to see first, students, the total taxable income, and it is mentioned already in, students, 28,700. See, the total taxable income is, students, 28,700. Now students, we need to determine the corporation tax rate, not corporation, capital gain tax. The capital gain tax rate, capital rate. So first thing, two things we need to look, students, the total taxable income and the type of asset disposed of. So first we have seen, okay, 28,700. So this is within the basic rate limit. So the basic rate limit still available will be, students, 37,700 minus 28,700. So the remaining basic rate limit is, students, 9,000. So and the type of asset disposed, here we have two types of asset disposed, residential property and other assets. So first the calculation of, first we'll need to calculate the income tax. We are done with it. As in a question, it is mentioned only to calculate the taxable income. So we'll be concentrating on that. And the type of asset is residential property and other assets. So the type of assets, only two distinction, residential, other. Now students, if it is residential properties, then the calculation, the order of calculating the tax, as already mentioned, first we'll calculate the income tax, then the income tax, the taxable gain will be treated as the top slice of income. And now to determine the rate, we need to see the type of asset disposed. So here we have residential property and other. So for residential property, first the capital gain tax will be calculated on residential property, then other. Same, the order of AEA will be residential property, then other gains, then other gains, students. So first residential property. Residential property gain is 28,300. So this 28,300 and 20,000. Now the rate will be applicable, students, here is, as it is within the basic rate limit, our band is 37,700 and our taxable gain. Let's draw a diagram, students. Our total taxable income is 28,700, students. Now here taxable gain will fall. This is 48,300, but our band is 37,700, so 9,000 is in the basic rate band. Above, it will be charged at higher rate. So now, students, first we'll charge the residential property. So students, the corporation tax will be the CGT, capital gain tax will be, students, the capital gain tax liability will be 9,000 basic rate. So basic rate residential property, basic rate, it is at 18%. This you need to learn the rate, students. It will be students, please do remember, you can start directly with other gains also, but we will start with these first because we have a tax saving. So let's this is the order, students. 18%, so it will be 9,000 into 18%, 1,620. This we have seen, students. Then the remaining of this is 28,300 minus 9,000, it is 10,000, 19,300 into 28%, it is 50,004. Then students, for other gains, it will be 20,000 into, as it is above this, already our basic rate band has been consumed, so higher rate, so it will be 20%. This will be, students, this will be 4,000. So our total CGT will be, students, our total CGT will be 11,024. It will be 11,024. But let students take an example. Let's calculate the CGT in any order. CGT liability. We will first calculate for other gains, then we'll calculate for this. First we'll calculate for this, then we'll calculate. So if you do this also, students, so 9,000 will be taxed at 10%, 900. Then the remaining 11,000 will be taxed at 20%. It will be 11,000 into plus 1,000, 2,200, and then remaining will be taxed at 28%. This will be, student, plus 7,924, and the saving will be, student, this will give rise to tax of 11,000. See here, students, first we calculated, in this case we need to follow the order. First we calculated for residential property, we got the answer of this. If we calculate first the tax for other gains, then also we are getting the same CGT liability. I hope this is it. As students, please do remember, we had studied a point here, the unused basic rate band. Whether you calculate this way or that way, the rate, the capital gain tax paid will be the same. I hope this point is clear now, students. This point is clear with the help of this example. Here first we calculated the residential property on residential property because it is paid at the highest rate. Then for other gains. But students, we are getting the same tax. The bands, the tax is the same. The tax is the same, students. The amount, the CGT tax, the capital gain tax is the same. But students, you need to keep in mind, whenever you calculate the CGT, you need to follow that order. The order, the set off for the AEA. AEA first will set off against the residential property, then other gains, and then BADR relief. But coming to the calculation of tax, first we'll calculate the income tax, then BADR. Why, students, I have mentioned the format? Because when we do the BADR format, when we do the BADR calculation also, it will be very confusing. So you need to follow first BADR, then residential, then other gains. I hope this point is clear, students. But either case you do, you get the same answer in this question. But when we have BADR, we need to follow that approach. But so from starting only, you follow the order of calculating the tax for CGTs, income tax, BADR investor relief will be covering, then residential property, then other gains. So now the CGT liability is less payment on account of residential property is given in the question as 7,860, student. It is 7,860. 7,860. So the CGT liability, the CGT payable will be, students, 11,024 minus 7,860. It is 3,164. I hope by solving this question, we are good to go with how to do the calculation for both residential and other gains. Whenever, students, please do remember the format. This is the format which we have already learned. But other gains, you need to reduce the AEA from residential property first, then other gains, because it is taxed at higher rate. That I hope is clear. Then, students, coming to the order of calculating the tax and the identification of the tax rate, we need to first see the total taxable income and then the type of asset disposed. The type of asset disposed is residential property, then residential rate will apply. Normal asset, other assets, other rates will be applicable. Other assets, here also other assets or other asset gain, other gain, students. Here let it be other gain. So then, already mentioned by me, we need to follow to calculate the tax. First we'll calculate the tax on residential property, as we have to submit within 60 days, that we'll calculate and submit it. But when coming to the annual calculation, student, when coming to the annual calculation, we need to calculate the tax first for residential and then other gains. If BADR is there, then BADR, residential, then other gains. But student, in this question, if you follow any of the approach, you will be getting the same answer. No issues in that. But you need to follow which is mentioned, so that when we calculate the CGT including the BADR relief, there will be no confusion. Then less payment on account. The payment on account will get our CGT payable. Now we will be doing one more question, students. E sold a commercial investment property. E sold a commercial investment property, students. E sold a commercial investment property on 1st July 2023 for 644,000. She had 644,000 pounds. She had acquired the building for 80,000 pounds in June 2005 and had extended it at a cost of 30,000 in June 2007. E also disposed of a painting on 1st September 2023 for 20,000, incurring auction fees of 1%. She had acquired the painting for 35,000. E had capital losses brought for 15,300. E's only source of income in the tax year 23 is the trading income. Calculate E's capital gain tax payable for the tax year 2023 and state the due date for the payment. Due date for the payment. Now students, here we need to follow from the step number 1 till the step number 3 till step number 5. Here we need to do the calculation for each and every step because they have not provided the chargeable gain directly. First we need to calculate the chargeable gains for commercial property. And it is commercial property, student, it is not a residential property. Please do not confuse between residential and commercial. They clearly specified. So all will be of one tax rate only, students. So it will be, students, our sales proceeds 644,000 less any cost she have incurred, students, for selling cost. No selling cost. So then less selling cost nothing is mentioned. So net chargeable, net disposal proceeds. So it will be 644,000 pounds, students. Then less allowable deduction, allowable expenditure, students. Cost of acquisition, it is mentioned 80,000 pounds and extended it at the cost of 30,000. So it will be allowed, students. It will be allowed. Enhancement expenditure 30,000, capital expenditure. So this will give rise to the chargeable gain, students. As we are doing the step number 1, students, for each asset separately we are calculating the chargeable gains. So the chargeable gains will be 534,000 pounds. Now coming to the case of painting. Selling proceeds, it is mentioned 20,000 pounds, students. Then less selling cost 1% of the proceeds. It will be, students, 20,000 into 1%. It will be 200. This is 20,000 into 1%. So we'll arise to the chargeable gain of 19,800 less cost of acquisition 35,000 pounds. Any enhancement cost, students? Nothing is mentioned. So the chargeable gains will be, students, 30. It will be 35. It will be allowable loss, students. Chargeable gains or allowable loss. So it will be, students, here negative 15,200. I hope this is the step 1 is done. Now coming to the step number 2, students. Now this we can directly write as the chargeable gains, that is 534,000 pounds less allowable loss, students. Allowable loss of current year, that is 15,200 we need to set off, so that we arrive to our net chargeable gain, students. The net chargeable gains is the second step. We have done the second step. So the format we need to follow this, students. After this, net chargeable gains will be, students, 534,000 pounds plus 15,200. It is 549,200 less, students, less any trade loss set off relief. Nothing. Less AEA students, yes, full it is available. Then less brought forward loss, yeah, we do have brought forward loss of 15,300 students. So this way will give rise to the taxable gains. So the taxable gains will be, students, so the taxable gains will be 4 430 497 500. Now students, we need to calculate the capital gain. Please do remember, students. Now we need to calculate the CGT, capital gains tax. Capital gain tax. Capital gain tax is calculated on the taxable gain 497,500, and students, we need to find the capital tax rate. This will depend on the total taxable income, student. The total taxable income, they are mentioned in the question. They have mentioned the trading income is 40,270, and it is mentioned only trading income source, students. Trading income is only the income source. So this will be 40,270 less the personal allowance, students, because the income is not more than 100,000 pounds. So PA will not be tapered. The total income will be same, net income will be same, and the taxable income will be, students, 40,270 less PA will be 27,700. Then the type of asset, as no residential property, so the rates will be same for all the assets. So the capital gain tax liability, the capital gain tax will be, students, as the basic rate limit is 37,700. So if within the basic rate limit it is 10%, so that is 10,000 students into 10 percentage, this is 1,000, and the remaining will be at 20% above basic rate limit 20,000, because students 37,000 is our limit, and this is falling within and some band we have, because the capital gain tax is calculated and the taxable gains will be treated as the top slice of the income. So after this you need to treat the capital gain tax, and our limit is 37,000, remaining is 10,000, excuse me, at 10%. Now the remaining, students, 487,500 into 20 percentage, 97,500. So this capital gain tax payable is 98,000. As no residential property, so no payment on account, so the capital gain tax payable is 98,500. I hope this is clear, students. By solving this question, we are good to go with the CGT calculation part. Do remember, students, the calculation of CGT first will be calculated on the taxable gains, and the taxable gains will be treated as the top slice of the income. Then we need to see whether basic rate band is available. If then we need to see the type of asset. If it's residential property, then first we'll calculate the income for the residential property, then other gains. And if residential property within the basic rate limit band, the tax is 10 and 18 percentage, and above that 20 and 28 percentage. I hope by solving this question we are good to go with the CGT calculation part. Now coming, and we have seen the order, students, for setting of the AA in capital loss. First residential property and then other gains. For the order of the calculation of tax, you need to follow the same, but if you will not follow, you will be getting the same answer. But students, further will be studying a BADR relief concept, in that we need to follow this format. So you need to follow the format which I have given. Now coming, and we have seen the payment of CGT is due on 31st Jan 2025 for the tax year of 23-24, but for residential property it must be paid within 30 days. Now CGT planning and opportunities. How we can plan the CGT so that we pay less tax? Delaying disposal until the following tax year. Tax saving. If the AEA has already been utilized in a particular tax year, delay the disposal of an asset until the following tax year. Well, so students, if we have disposed of an asset in a year and we have already used the AEA, but if we are planning to further dispose of an asset, then we need to pay CGT, no? So the better way would be to dispose of the asset in next year. If the AEA has already been utilized in the particular tax year, delaying the disposal of an asset until the following tax year will allow the offset of the later year AEA against the gain rising. So let's take an example, students. Tax year of 22, 23 and 23, 24. We disposed of an asset and we had a gain of 10,000 pounds. In this year, we dispose of further asset and the gain is 10,000. And this year, no disposal. Again, 24, 25, we have a disposal. So, if students, you see here, you have 20,000 disposal. So, only 6,000 you can claim AEA. On further amount, you need to pay the CGT. But students, you can plan in a such a way that you can reduce your CGT. This is known as tax avoidance, students. This is using the tax rules properly in a legal way so that we can minimize our tax paid. So then instead of disposing this asset this year, you dispose of the next year so that the AE of this year will also be applicable and the AE of this year also will be used, so that you will have a small rate of tax. Allow the offset of the later year AE against the gain rising, thereby saving tax on the further 6,000. If you pay your students, you will be paying at the tax will be paid at 14,000, but if you split, you will be paying the tax on 8,000 only. So the profit is done on the tax saving is done on 6,000 pounds. If the individual is a basic rate taxpayer and taxable income is lower in subsequent years, delaying the disposal would mean that more of the basic rate band would be available and therefore more of the resulting taxable gains could be taxed at 10% or 18% for resident. So students, if a taxpayer is assuming that his total taxable income for future years will be too less such that the basic rate band will be available. So what he can do? He can dispose of the asset in future years. He can dispose of the asset in future years, students, so that he will pay the tax at smaller rate, that is the 10 and 18%. Cash flow advantage. This for the tax saving. Tax saving can be done, students. We can dispose of the asset next year so that we can use our AEA. Or if we assume, or the individual is assuming that the total taxable income will be low in a certain period, they can dispose or delay the disposal so that they can pay the tax at 10 or 18%. Now coming to cash flow advantages. Gains realized on disposal up to and including 5th April 2024 are taxable in the tax year 23-24 and associated CGT is payable by 31st January 2025. So students, if a company is facing cash flow problems and it needs a cash flow advantage, then they can delay the disposal such that the liability will be paid by, if they dispose this year, they need to pay on 31st Jan, within 31st Jan 2001. If they dispose of next year, then they need to pay 31st Jan 23-24, students. Excuse me. If they dispose in 24-25, the CGT will be payable, students, by 31st Jan 2026. If the disposal later in the tax year can be delayed until 6th April 2024 or later, the gain is realized in the tax year 24-25. You can claim the AE also, and the CGT is paid 1 year later by 31st Jan 2026. So this is a planning question, students. This you need to see the situation of the individual so that you can minimize the tax planning. Students, we have covered the tax saving. and cash flow advantage. Now we will be seeing how we can plan for CGT. We can also reduce the CGT by planning and selling assets in small parts, where assets can be split, and sold in small parts in each year, so that we can claim the overall AE and it will result in lower taxable gains. I hope this is clear, students. The CGT planning opportunities are tax planning. Either we can dispose of the asset in next year so that we can use the AEA, or we can dispose of in the year in which the taxpayer is assuming that subsequent years they will be having a lower taxable income. Then if cash flow advantage means we need to set off or dispose of in next year, such that the CGT will be payable after 1 year. And if we sell assets in small parts, so that we can use the AEA and it will result in lower tax payable. I hope the CGT planning opportunities is also clear, students. So by completing this topic, we have completed our chapter. I hope, students, today's session was very interesting. If you have any doubts, please do message in the group so that your query gets solved. Have a good day. Bye bye, students.